Okay, and welcome back, students who are taking Math for Business and Finance and Math Applications, and we're looking at the theory for Chapter 16. This is video 10, and we're talking about how to read, analyze, and interpret financial reports, and we're going through the ratios. And so now we're up to, let's see here, the average days collection. Okay, and this one confuses students a little bit because of the way it's presented in the textbook. Okay, I wrote out the formula here. And because of the way it's shown in the textbook with the divisor line, is not conducive as to be able to tell at a glance what you're dividing. Okay, the way it's presented is that it has the accounts receivable, okay, and then it has the net sales, and then it has 360. And because of the way the divisor lines are, that's that line and that line, students sometimes get confused. Well, if you have divisor lines, then you should always start from the bottom and work its way up. Okay. In this case here, you take 360 and divide it into the net sales, and then whatever you get for that, you would divide into the accounts receivable. Okay, so I wrote the formula like this. If I were to write it by hand, and I'm trying to do a real good job of this, and I'm running out of space, so if I were to write this formula by hand, the accounts receivable is in the numerator. Okay, in the denominator, we're going to take our net sales and divide our net sales by 360. Okay, so like I said, we're going to start from the bottom and work our way up. So whatever our net sales are, we're taking 360 and dividing into the net sales, and then whatever we get for that in the denominator. Okay, remember that this all here is in the denominator. We have to do that order of operation first, and whatever we get for that amount, then we divide it into the accounts receivable. So and I'll just use the numbers in the book. Okay, I'm not going to do the math. They had accounts receivable of 9,000, and then they had that the net sales of 20,566. Okay, and they had it divided by 360, and students wouldn't be sure of, well, what am I supposed to be dividing? Am I supposed to divide 2566 into 9,000 and then take that divided by 360? Or do I take the 360, divide it into the 20,000, and then get that answer divided into the 9,000? Again, what we would end up doing is we work from the bottom up, and we would divide the 360 into the 20,566. That would be the first thing, and whatever we got for that amount, okay, we would divide that into the 9,000. Divide that into the 9,000. Okay, and that would give us the 100. It was like 157 point something days. Okay, and because it's greater than one, it's a partial day, we round up to 158 days. Okay, so that's how the average days collection works. And if you think of it in terms of concept, we're talking about average days collection. Average days. If we have our sales, and we want to know what our sales are per day on average, we're going to divide by 360. Okay, and since we're talking about collection, well, we're waiting to receive our accounts receivable. So we're going to take that figure and divide that into our accounts receivable in order to know how much on our receivable side, what the average days collection is. Okay, hope that made sense. And if not, watch the video again, or feel free to give us a call and we'll go over it with you. Most students who see it, get it, and they understand how to do the math. Okay, but if not, feel free to give us a call. Okay, total debt to total assets. Okay, what we're talking about here, total debt, which is our liabilities, what we owe, right, to our total assets. So very simple, total liabilities over total assets. And again, on your balance sheet, these figures will be clearly marked, because why? On our on the balance sheet we have our assets equals our liabilities plus our equity. Okay, well, we need to know what our total assets are, so that number has to be on the balance sheet. Okay, and we have to be able to add our total liabilities to our equity. Okay, so that number has to be on the balance sheet also. Right? And all we're doing here with this ratio is we're trying to see whether we have enough assets to cover our, what we own. That's what assets are, things that we own, OWN, right? Assets we own versus our liabilities, what we owe. Do we have enough in assets in order to cover, what we owe out? Okay, and if we do, right, then the remainder is, goes into equity, or what is known as our net worth, right? And that's what the investors who are interested in the business, they want to be able to know that if I put my money into this business, will I be able to get my money back out? Well, they can quickly take a look to see if the company is more debt ridden versus what they own, or in the opposite fashion. Okay, return on equity. All right, return on equity is simply that. If I put money into the business, right, what's my return? How much am I going to get back? So as you can see, it's net income over your stockholders' equity. Well, my net income is my profit or loss. That is found on the income statement. The stockholders' equity is, of course, found on the balance sheet. And the purpose behind this ratio is to be able to say, what kind of return am I getting? I mean, obviously, if I have a loss, right, let's say I have a minus 10,000 as net income, and I have 100,000 as equity, I'm going to have a negative return, right? A negative percentage. I don't want that. I want to be able to have a positive percentage. I want to be able to have 10,000 divided by 100,000, or what would that be? 10% return. Okay. And they use the return on equity in and of itself is not useful. It's more useful in comparison to something else, meaning, it could be used in various ways. And, how is January my return on equity as compared to February's return on equity, or year over year? Last year, right, 2014 versus 2015. Okay, or company A versus company B. Oops. Versus company B, right? My return on equity for company A is 10%. For company B, it's 11.5%. Well, which one do I want to put my money into? I'd be more inclined to put my money into company B, right? Because I'm getting a greater return on the money I invest. Okay. All right. Asset turnover. Let me see how many more I have to go here. Just 2 more. Okay. We'll finish out on this video. Okay, asset turnover. Okay, my net sales divided by my total assets. Right? You think about asset turnover. Well, my total assets, you're going to find that on the balance sheet, and your net sales. And notice it's net sales. Okay, is going to be found on your income statement. And why is it net sales? Well, if you look at your income statement, you're going to have sales. and we covered this earlier. Let me back up here and just use the word revenues. I have revenues less expenses gives me a profit or loss. Okay. Well, in my revenue section, I can expand that out. I can show my sales. Okay. And I had said I can show my cost of goods sold. In other words, I spent $100 on that table and I'm selling it for $500. My gross profit is $400. Okay, and that's fine, right? But I can expand this further. In the sales section, I can show, my gross sales, meaning the absolute everything that I sell regardless. Okay, and then I can take out less my sales returns and allowances. Okay, so these are items that are returned or allowances that I make, or I can also take out less sales discounts. Okay, so if I have let's say I have $100,000 for gross sales, and I have $5,000 of merchandise that was returned, and I had $2,000 in discounts. Okay, this is negative because it's less, right? Then I have my net sales is going to be $93,000. Okay, it's the net. It's the net means that the final calculation. Okay, so I have my net sales, the total of my sales after I take out everything else, and I'm dividing that by my total assets in order to be able to see how quickly I'm turning my my assets over. Okay, and basically that has to deal a lot with your inventory. Okay, so last one here, profit margin on net sales. Okay, and this is basically the same as the asset turnover. Okay, I have my net income over. Let me erase that and go into red. I have my net income over my net sales. Okay, both of these are shown on the income statement. Okay. We know the net income, again, our revenues less expenses gives us a profit or loss, or our net income. Okay, and we know what our net sales is because I just got done explaining that. Okay, so that's giving me a profit margin on my net sales. Okay, meaning how much money am I making in as a margin, as a percentage, okay, on my net sales. Right? So with that said, I kind of went over these here, all right, and even though I didn't give a lot of specific examples, and I wasn't going to be bouncing back and forth between the balance sheet and the income statement in order to be able to show you where these numbers come from, right? By doing enough of the problems, you'll start to see where the numbers come from. And like I said, if you understand the concepts, it'll be easier for you to be able to put things together. But at first, kind of memorize so that you know what to look for when you go to look for it. Okay. One of the other things that I didn't, touch on here, or I didn't bring up, is that I wasn't using a lot of numbers here. Okay. And sometimes to be able to understand these ratios, it helps to plug in numbers, okay, and see what the effects are, okay. And I'm just going to give a quick example of it here. And I realize that I'm not talking about a ratio here, but to give you an idea, I'm just trying to point you in the right direction. If I have revenue of say 100,000 and I have a cost of goods sold of say 75,000, that means my gross profit is going to be 25,000. Okay, if my expenses are 35,000, okay, that means I have a profit or a loss of 10,000. Okay, now what if I'm able to, from a cost of goods sold perspective, my gross margin on my gross profit, my gross margin on what I'm selling is only 25%. Okay, and you see this an awful lot in the restaurant industry. You know, they work on these very, very low margins, okay, 25%, and they have to pay off all of those expenses with that low margin. But what if they're able to bump that up to, say, 35%, okay? And the way they bump it up is, you know, they're able to get the food at, you know, they go out and they hire, say, a food manager, and he's able to go out and do a little research, and he finds out that, well, you know, in his costs instead of 75,000, he's able to get the same amount of food for 65,000. Well, now my gross profit is 35,000, my expenses, and now I'm at break even. Okay, and I don't have a loss. Okay, now notice what I just did. I played around with the numbers. Okay, the reason why I gave you this example instead of actually using a ratio, okay, one of the different ratios that we've learned is because you can play around with those numbers yourself to see what effects happen with the ratio. I mean, you know, take your current assets and your current liabilities, right? Your current ratio. And sure, if you're looking at a balance sheet, you know, you're able to find the numbers and plug them in, okay, and come up with that, you know, whatever amount as that ratio. Well, then go back and, you know, if you've looked at it, you start looking at a lot of financial statements, you know, you get a feel for it, but you can go back in and plug in a different number for your current assets, or plug in a different number for your current liabilities and see what effect it has on that ratio. And then you start to be able to understand intuitively, you know, what those ratios do for you. And then that allows you to be able to make better decisions. Okay? But right now we're talking about high level. Okay, and it's enough right now in order to be able to just know what the ratios are. Okay, so with that, you know, I'm done. And again, I'm done with the theory for this chapter. And you know, when I looked at the problems, you know, we don't have too many problems to do as far as drill problems and word problems. However, the ones that we do are going to cover an awful lot of this, so you get a good practical experience. And as I'm doing, you know, like I said, since I do this stuff just ad hoc and as if I was a student, you'll hear my thought processes and things that jump into my head as I work through the problems. Okay, so I will see you all in the drill problems going forward.